In this week's update, semiconductors in big breakout. US small caps running again. Forward earnings growth supports the US rally, and precious metals are stronger. My name is Garry Davis, and as always, this is general advice, and please remember to like and subscribe to the video. Let's start with our usual market perspective. US earnings season is progressing very nicely and going as I guess as well as expectations would have set. And the US economy is also ticking along quite well also. And if you look at the charts, because at the end of the day, it's what the charts are telling you more than, you know, perhaps government figures that might be manipulated or media that might just not have the right story. But if you look at the charts, then, you know, that's telling you exactly where the money flows are going and what's happening. And we've got the XLK, which is the technology sector, and we've got XLY, which is consumer discretionary. They are the aggressive sectors of the stock market, and they're setting a very aggressive backdrop to the overall US market. Money does not flow into those sectors, you know, unless the outlook remains pretty bullish. And then if we dig a little deeper, we look at IWM, which is the Russell 2000 ETF, has just broken out. We look at the mid-cap 400 stocks, which I think is the most impressive chart because this one excludes all the major large-cap stocks. This is the 400 mid-cap stocks, and that index is breaking out as well. The transport sector, which is always a great indicator, is continuing to rise. And now we've got a breakout in the XLI, which is the industrial sector as well. So it just adds enormous conviction to where the US stock market is going. And I know some people feel that it just can't keep rising. But as I covered last week when I showed that example around Microsoft, the market isn't particularly expensive. And certainly some stocks are not particularly expensive given the environment, and earnings are growing nicely. So there's no reason that the market can't continue to advance, albeit with some pullbacks along the way. But overall, if you look out over the next few years, it's very hard not to conclude that the index is going to continue to be higher. So the message this week, as pretty much always, is just keep doing the simple things well. You know, don't try and overthink it. And it raises a question, why does logical conclusion let us down? You know, it's logical to think that if the market has been going up for as long as it has, all the problems that are out there with respect to China and trade and debt and all those sort of things, you can amass an enormous list of problems that could bring the stock market down. But it never happens. So why does logical conclusion not really work out? And to me, the answer is that we just don't take account of all the information that's at our disposal. It's natural to have a bias. It's natural to seize on the information that, you know, validates your basic thinking, and to not see the information that gives you the bigger picture. And that's why at the end of the day, you know, if you look at charts, that tells you all that you need to know about where the money is flowing. And finally, on this point, there are just so many people these days that live in fear of a major top in the market, and they've probably been in that position for years and years. They've missed out on enormous rises in the market, and if they, you know, continue to live in this fear of a top, it's really a lousy way to live, in my view. You just, you know, go with what is, have a game plan that reflects your particular style, be it aggressive or conservative. Just focus on that. Stick to the plan, execute it well, do the simple things well, and you'll probably come up with a pretty good result rather than trying to second guess where the market's going. All right, let's turn to American stocks. The S&P was up 2% for the week, closed just a tick under 4,700, but did manage to go above 4,700 for the first time in history. And it was the 16th gain in the last 17 sessions on Friday. So very, very impressive. But the main thing is the market breadth. To me, it's one thing for the Apples and the Microsofts and the Googles and all those stocks to be leading the way and having an overweight influence on the index. But when you see the mid caps and the small caps running as well, the market breadth really is very impressive and therefore highly likely to be sustainable. Now, semiconductors are doing as well as any sector out there. They had a terrific week. The semiconductor index was up 8%, which is a lot for an overall index. Not so much for a specific stock, but for an overall index as broad as the semiconductor one is. That's a very, very good gain. The US dollar was higher, 94.22. It did run up to the resistance that I've been pointing to now for some months, which is around 94.7, but did pull back from that resistance level. The 10-year yield ticked down a little bit, down to 1.45, and we just seem to be carving out a range there now between about 1.4 and 1.6. And the VIX finished pretty much where it was last week and the week before at around 16.5. So let's look at some charts. And we'll start with some of the, I think, the more important ones, rather than just looking at the S&P, which that's a reflection of what a lot of the large cap stocks are doing. But I think this gives you much more of a flavour of what's happening underneath the hood in the market. So this is the Russell 1000 growth versus 1000 value, obviously influenced by the larger stocks. But you can see we're rising quite steeply. We had a little bit of a pullback in September, but since then we've been rising very steeply. And October was a very good month, and the money is flowing more into the growth rather than the defensive sectors of the market. So that one is pretty clear. This is the small cap growth versus small cap value, and it's not as clear cut there, but I read that in combination with other things that money is really flowing into small caps, period. And it's neither growth nor value. It's flowing into both when you look at the absolute charts as well, which we'll get to in a minute. This is consumer discretionary divided by consumer staples. So this is how bullish, how aggressive the market is, and it's just off the charts. Now that is being influenced by the performance of Netflix, and also Tesla, I think, is in that index. So those two big cap stocks are having an influence. But again, if you look at, break it down into some of the industry groups, you look at home improvements, you look at furnishings, you look at dozens of different components of the market, and it's the aggressive sectors and the consumer orientated sectors that are doing well. Okay, so let's now look at the S&P. So you can see a bit of an indecisive finish in the end. We gapped up in the S&P, traded up to 47.18, finished just a tick under 4,700, and we're quite elevated above the 20-day and the 50-day moving average. So we might get a bit of a consolidation or a pullback in the next week or two. This is unsustainable. This rise in the short term from basically the 14th of October. So we will get some cooling off of the index, but I don't think it's going to amount to very much when you look at all the signs. The Nasdaq is also in breakout, as you can see, very, very strong. But this is the important one, along with a couple of others. So this is IWM, the Russell 2000, that had been in consolidation since February. So in this pretty tight band between 210 and 233. That's a very narrow band to be in for 9 months. But look at the breakout and look at the volumes. Now this is a very broad-based index, obviously. So it takes a lot of money to make the chart look like this, to get a breakout like this on volumes of this nature. So fund managers are committing significant amounts of money to the market, and they're not going to wake up next week and decide that they're going to change their view. These are buying campaigns that go on for weeks and months. They don't just switch them on and off. They're not speculating here. They're moving vast sums of money. And now with small caps breaking out, we're now seeing funds starting to come back into that area of the market. There's definitely interest. It's unmistakable that money is now starting to flow back into small caps. If we look at MDY, which is the mid cap 400, so again, this takes out of play the impact of the very large stocks. Consolidation from April, nice breakout, good volumes. So that's certainly looking very positive as well. Semiconductor index, SMH, has also now broken out. Really strong volume, particularly on Thursday and Friday. And most of the semiconductors now are doing a lot better, despite the supply chain issues that still exist. But the market's always forward-looking. So the market's looking 6-12 months ahead. And so they're expecting that those supply chain issues will become less and less of an issue. If we look at transports, hasn't broken out yet, but you can see it's right up there at a double top, which it tested on Friday. And this is the industrials. So finally, the industrials looking like they've set basically a new all-time high on Friday. So the industrial sector is now joining in as well. So wherever you go, and just breaking this down one more, so this is now industrial small caps. So PSCI is the small caps for the industrial sector, and that has broken out quite robustly as well. So wherever you go in the US market, it's a very, very bullish story. And there is XLK, and that's XLY, just to complete the picture. Now turning to currencies, there's the US dollar. We had a run up to 94.7, didn't quite make it, but the short to medium term trend is up, and the highly likely outcome is that the US dollar will break higher from here. So that naturally is keeping some pressure on the Australian dollar, which closed at 73.5. So the ASX 200 index was up 1.8% for the week. The big winners were healthcare and the small cap sector in Australia. So XSO did quite well. We're seeing lagging performance from the commodity stocks, materials, and also energy. But lithium stocks continue to do exceptionally well. They've run very hard, but there's no end in sight for the buying momentum at this point in time. Turning now to precious metals, gold did very well despite the fact that the US dollar was up. So we're now starting to see a bit of a reflection of, perhaps concerns over inflation, perhaps coming through. So gold was up $35 to 18.18, and that was the highest level for gold in 2 months. So things are looking a little bit better there. GDX, as we'll see in a minute, is also starting to look a bit more positive. So we'll start with gold. So there's gold on a weekly chart, and you can see we're just on the cusp of breaking out of this downtrending channel. Hasn't quite done it yet, but it's certainly looking a lot better than what it was back here earlier in the year and back into the latter part of 2020. So you can see quite a strong move on Thursday and Friday for gold. Whether it's whether it's the start of a new move to the upside, time will tell. We certainly need to get above these levels here for that to be the case. That's about 1833 at the moment. Silver is not really outperforming gold at this point in time. It's pretty much in line. And if we look at GDX, again, we haven't managed to break out. So the gold miners are not really leading yet. The two parts of the precious metals complex, the stocks and the underlying metal, are pretty much going step by step at the moment. But it is looking more positive than when we got this breakdown that occurred in September. Turning now to other commodities, copper was finished at 444, nickel at 891. And if you look at copper, there's only 5 new copper mines are due in the next year. None of them are in tier 1 locations, being Australia and North America, etc. And all of them have significant risk. So these are copper mines of some global significance, and there's certainly a level of risk around them. And if you look out further, the pipeline of new significant projects is looking very thin, and you don't do the exploration and the discovery and all the permitting and the financing and everything else, the building. You're looking 5 to 10 years. So anything that's not really known about at this stage is probably not going to have an impact on the copper supply situation this decade. And if you look at the supply and demand, the demand is clearly going to continue to increase, and the supply is problematic. So the outlook for copper, as it is with nickel and tin and just about any commodity you want to look at the moment, is very robust. So there's certainly good investing opportunities over the long term. There's no question about that. Crude oil was a bit lower to just a tick under $80 now, and it looks like the energy sector is taking a bit of a breather. So there's the spot copper chart. Didn't really move much during the week, and neither did nickel, pretty much sideways. So wrapping it all up, again, just the message here is just keep doing simple things well. Don't try and outthink the market, even though everything in your being is screaming that the markets are got to be overvalued and therefore it's got to come off. The fact is that it's not. There will be some sort of correction, but if you look at everything on balance at the moment that I've gone through today, it's very hard to say that it's going to be a correction of any real significance. It might just be some sort of mild 3 to 5% pullback again. The important thing here is to understand what your profit-taking signals look like. There's no need to bail out of the market. It's not going to suddenly collapse overnight, unless something completely out of left field happens. But it's not going to collapse overnight. So I just understand what your profit-taking signals look like, because if you've got out of a stock prematurely, then that could have been an enormous amount of wealth that you've turned your back on. So you want to stay in the market when it's doing what it's doing, but just be clear what the profit-taking signal looks like. Don't leave it until things start to come unravelled, and then you're making decisions based on emotion. That's not the way to do it. Just be clear what they look like. Watch it every day, and when the signals are there, then act on them. But if they're not there, then just leave it alone. Portfolio analyst last week, we looked at helium. There's been a lot of airplay given to hydrogen of late, and we looked at that a couple of weeks ago, but we dealt with helium last week, and also there was another new addition to the US multi-bagger portfolio as well. So pretty good session in Portfolio Analyst. That's it for this week. There's more information on the website. There's an email address you can contact me on, and I'll be back with you next weekend. Cheers.